Hey, welcome investors to the 40 Finance channel. Today I'm talking about e-commerce stocks. And with this recent meltdown in the market, I've been getting a little concerned about e-commerce stocks and the valuation multiple that they could potentially trade at. So I'm going to walk you through that, show you what I've seen, at least from a historical basis. So the goal here is really just to try to figure out what the floor might be from a valuation multiple in let's just say the worst of times. And that way when you're watching your Etsy's and your Shopify's and your MELIs, you can kind of figure out, hey, is this really a good deal or did the stock price just come down a lot? Now, as I alluded to in the beginning, the first place I want to start is to use kind of eBay as our look back in the past and try to figure out where was this one trading. eBay, obviously, when they started, came out very hot, right? It was a totally new application or website, and they grew significantly. And now they're a little bit older in their business cycle, and the focus, of course, is mostly on generating EPS. It's not so much a user score anymore, it's a making money score. So if we go into Yahoo, we sort by annual, this is a premium feature, just FYI if you don't see it on your own screen. And we want to go way back, okay? We want to go probably closer to 2000 if we can. Yeah, this is sort of the peak growing time for eBay, heading into 03, 04. You had 265, 41, 32. But then here around 08, when this growth stalled, and we also had, of course, the great financial crisis, you had a trailing PE of 10, okay? And let's just get past the great financial crisis for a second. Skip ahead to 2010 into 2013, you're in the 25s. And if we go to sort of what I've been using as a rising interest rate environment, that would be 16 through 21, trailing PE below 20, forward PE landing around 15. All right, so that was eBay, which to me is a really good example because eBay doesn't really own products, right? They run the marketplace, very similar to what Etsy does. Then you have stocks like Amazon, but Amazon's really hard to compare because of how big AWS is to their bottom line, particularly margins and profits. Now, as an Amazon stockholder, I will say I've been getting a little nervous about their valuation multiple because if AWS doesn't keep growing plus double digits, there could be a maturation process in Amazon stock where instead of getting 50, 60 PE ratios, it starts to drop down to the 30s. So Amazon's number one. I'm not sure it's the best apples to apples comparison. Walmart here in the United States comes in at number two. Again, such a big store footprint, it's hard to compare them. eBay's in here at 40 billion. Then you have Apple. And even though the Apple stores are popular destinations, the truth is, if you see this number, ecom sales of 35 billion, they do pretty well online as well. So let's take a look at Apple's valuation history. And I'm going to scroll back a little bit. Let's go to 2010, trailing PE, under 20, forward PE, basically under 15. Now that was through 2014. Let me scroll this a little bit. And you have 11, 12, 14, 16, 17, all the way up to COVID times. So no matter how you slice and dice it, whether it's trailing or forward, you're still under 20 for PE ratio for Apple. That, by the way, was very similar to what we saw with eBay as soon as they started slowing down. Okay, so as I mentioned, I'm getting a little nervous about which way valuations can go for e-commerce companies, particularly my Amazon stock, and I've also been looking at Etsy. So I put together this comparison for us on SeekingAlpha to just take a look with, maybe who's the most at risk here. And just to confirm, I mean, I think e-commerce is a great place to invest when you think about the runway for the future and how many more sales are going to be online versus, retail store footprints. However, in this particular environment that we find ourselves in to kick off 2022, I just think that we have to be careful with the valuations that we buy at and protect from the bottom if at all possible. So here's who I have in my Seeking Alpha comparison: Amazon, Baba, MELI, Etsy, Shopify, eBay. Of these six, Shopify is probably the odd man out. They're not even in the same industry technically. But as far as I'm concerned, if e-commerce is going well, generally across the United States anyway, then Shopify, of course, is going to benefit. All right, so let's take a look at our valuations first. All right, looking at the forward PE under GAAP, you have 68 for Amazon, 21 for Baba, 325 for MELI, 45 for Etsy, 31 for Shopify, and 23 for eBay. So if you're going to throw those numbers at me, I would say that Alibaba and eBay are right in line with some of the numbers we saw in history. Perhaps not bargain basement, but we also have to figure out who's growing the most, right? So in the case of Shopify and Etsy, you might get a slightly higher multiple if they're growing significantly more compared to the other ones. Now, in my personal portfolio, this Amazon PE right now looks bad, right? In fact, it's rising from the year before, 54 to 68. Never a good sign there. I would be very uncomfortable with that, except I also know that Amazon is putting billions of dollars into their logistics network, and those projects hopefully are going to be completed, the spending portion, by the back half of 2022, and then you'll start seeing more of a compounding EPS from there. So I feel good where Amazon's going, but certainly right now, just on straight up metrics, if you don't have that understanding of what the company's doing in the future, then it doesn't look like the greatest pick of all time out of these six stocks. Now, in terms of MELI, again, let's figure out how they're growing. Their P's coming down 50% this year if they hit their target numbers. So even though that's a pretty hefty premium compared to the others, let's just see what the growth scores look like. All right, so let's look at those growth scores. By the way, if you're interested in learning more about SeekingAlpha, which is the platform I'm using right here, I have a significant discount for you with my affiliate link. That is in the description. This is a website I use all the time. And I think perhaps most importantly in this day and age, if you combine the community writers with the stock analysts, I don't think that there's another website that's going to give you so many individual opinions on a stock. And I think that's important because, as we know, some of the herd picks, if you will, last year didn't fare so well heading into 2022. Okay, so let's see what our friends are doing down here. I'm just going to skip ahead to revenue growth forward. All right, 25% estimated for Amazon. Alibaba, 30%. MELI, which we identified as having a high multiple, that could be 60%. Etsy right up there with them at 50%, Shopify 56%, and eBay here basically treading water, right? So if we think back to those valuations, and we know that Alibaba and eBay were the cheapest, it certainly would seem to make sense to purchase Alibaba over eBay, at least from my desk. But obviously you have some government concerns in there, and it really just depends on your risk appetite. When you start to stack up Amazon versus MELI, Etsy, and Shopify, I think there can be a case made for all of these. Amazon and MELI are probably the most diversified as businesses. MELI is basically a clone of Amazon except for South America. Etsy is one that I've been in before, and I'm sort of attracted to it because they just focus on running the platform, running services, there's probably a little less growth margin in there, but you can see when we break this out to a 5-year CAGR, which, just to be clear, I'm always a little skeptical of any sort of 5-year projection from anybody, but let's just roll with it for entertainment. 29% for Amazon, 45% for Baba, MELI 52%, Etsy 45%, Shopify 66%, and eBay 5%. So Alibaba, no surprise with its rundown. It's probably in the best position. It just depends on if you can handle the fact that the government could close the whole thing down on any given day. That's the hardest risk with that one. Between MELI, Etsy, and Shopify, it looks like Shopify is leading the way. All right, now let's look at profit margins. So Amazon running 41%, Alibaba 38%, MELI 47%, Etsy, Shopify, eBay 73, 54, 72. So all of these companies have pretty good profit margins. You can see the difference though with Etsy and eBay, how that margin expands significantly when you don't have to deal with purchasing, storing, and everything else with physical products, right? When you just run the platform, things get a lot easier. All right, lastly here, let's just take a look at revenue and debt here. So Amazon, the behemoth, $457 billion, which is more than all of these guys combined. I don't know how surprising that is anymore, but $909 a share. And this to me is some of the safety you get with the Amazon stock, right? It's not going anywhere. And better chances than not, in 5 years, it will be a bigger company than it is today. From there, in order of size, you have Alibaba, eBay, MELI, Shopify, and then Etsy's the smallest at $2.23 billion. All right, what about cash and debt? $78 billion for Amazon, $71 for Baba, $1 billion for MELI. Etsy's under $1 billion at $816 million. Shopify $7.5 billion. eBay $14 billion. Now, long-term debt. Amazon $55 billion. Sounds like a lot of money, but keep in mind it's less than the cash that they hold. Alibaba sort of in the same position, if not better. MELI $2 billion. They have $1.29 billion in cash, and they generate $6 billion in sales. So I would say that MELI is probably in a good place to service their debt, but it's probably the higher ratio that we've seen right now. Etsy, $2.27 billion debt. So this one gets a little more interesting because remember, MELI makes $6 billion, Etsy makes $2 billion, and they have $2 billion in long-term debt. They also have the lowest cash holding. Now, I'm not suggesting that Etsy is going out of business here, but across all these companies, they probably have the worst margin of revenue to long-term debt. Shopify, $7 billion in cash. Looks like actually no debt for Shopify, so great accounting there. And eBay, $7 billion in debt, $14 billion in cash. They bring in $11 billion, no real sound alarms there. All right, so what's the bottom line for that comparison there? Well, the way I see it, across those 6 companies, for me personally, eBay's out because they're not growing at all. And I'm really looking for double-digit growth rate, ideally on the top and the bottom line. eBay's not a contender, so it's just not my style of investing right now. On the Amazon front, this is a stock I already own. They have earnings on Tuesday, and quite honestly, that's what I'm waiting for. It'll be interesting to hear the updates on their logistics spending and where they see 2022. So I believe in Amazon, and even if they have a tough couple quarters here to start the year because of all the money they're investing, I'm okay with that. Alibaba, for me, it's out. I don't normally buy Chinese individual stocks, and I'm not going to start today with all the stuff going on. I will say that under every fundamental metric you could possibly find, It certainly looks like a buy right now. So similar to eBay, but for a different reason, it just doesn't fit my style of investing, so I'm out on Baba. So the final three, MELI, Shopify, Etsy, have all had their ebbs and flows as growth darlings, right? And going through that stock comparison on so many levels, I gotta say, like, the Shopify really opened my eyes a little bit. I also think that over the long term, Shopify could potentially command higher valuations because it's basically a software company, right? Now, as far as Etsy, which is one I've owned in the past, I will still consider Etsy across the board. It will be interesting to hear how they did in their holiday season, but I do project that there could be some weakness in Q2 and Q3. I already know that because I own the stock, and basically summertime's a bust for Etsy. So I think you have time to invest in this one. You really want to get in probably by September, October, before the Q4 holidays come through. All right, and then that leaves MELI, which I'm interested in MELI, but with MELI, as much as I'm intrigued, there's a lot to that company that I just don't know. Never used the service. Frankly, I've never been to South America. So I find it hard, for me anyway, to invest in that company. And I've said on the show many times, I have my concerns about the economies of the places they do business, right? Brazil's not exactly known as a world-class economy, okay? Just to put that out there. So what happens if fiat currency levels change and exchange rates change? It's very, very hard to understand the risks of those things, at least with my level of understanding. Now, keep in mind, we did that eBay look at the very beginning on where PEs could go for these e-commerce stocks. Now, just to be fair, eBay is not growing like they were in 1995 or whatever year they came out, right? Shopify is, Etsy is, MELI is, and even Amazon's doing better than where eBay is right now. So what is the delta between eBay's P ratio and where these other guys are growing? That's the hard part. But at least at this pullback, perhaps you can start buying, sprinkling in a couple shares here and there, and hopefully over the long term, it'll be a great investment. All right, guys, let me know what you think about these ecom stocks and where you think they're headed here in 2022. Also, don't forget to check out the Seeking Alpha special offer in the description. Hope you enjoyed this video. Please give it a like, share with your friends. We'll see you on the next one.